The most dangerous real estate in the world right now isn't a trench in Eastern Europe or a disputed island in the South China Sea. It's a renovation project at 20th Street and Constitution Avenue in Washington, D.C. You might think I'm joking. You might think, what does a construction project have to do with my portfolio? Everything. Absolutely everything. Because as of this morning, January 15, 2026, the United States Department of Justice isn't just looking at blueprints. They have served grand jury subpoenas to the Federal Reserve. They are investigating Fed Chair Jerome Powell. And the accusation? It's not about monetary policy. It's not about failing to spot a recession. It's about the renovation of the Fed's headquarters. Let's call this what it is. This is the financial equivalent of a mob hit using a parking ticket as the weapon. President Trump, back in the Oval Office, just gave an interview to Reuters. He says he has no plan to fire Powell right now. He says it's too early to tell if this probe gives him the legal ammunition, the cause, to terminate the world's most powerful banker before his term ends in May. But here is the line that should send a shiver down the spine of every investor from Wall Street to London. When asked about Republican lawmakers criticizing this probe as political interference, Trump said, and I quote, "I don't care. There's nothing to say. They should be loyal. That's what I say. Loyal. Not competent. Not independent. Loyal. If the Federal Reserve loses its independence, if the printer of the US dollar becomes a political arm of the White House, the rules of the global financial game change overnight. The risk-free rate becomes risky. The bond market breaks. And your retirement account? It becomes collateral damage. Today, we are peeling back the layers of this constitutional crisis. We're going to look at the legal nuclear option Trump is teasing, the two Kevins waiting in the wings to take over, and why this specific battle in 2026 could trigger a market volatility event worse than 2008. Buckle up. The Fed is under siege. Let's strip away the noise and look at the weapon being used here. The renovation probe. On the surface, it sounds bureaucratic. Boring, even. The Fed is renovating its buildings, maybe costs overran, maybe a contract was awarded weirdly. In a normal timeline, this is an internal audit. It's page 14 news. But this is not a normal timeline. This is the Al Capone strategy. For those who don't know their history, the FBI couldn't catch the gangster Al Capone for murder or racketeering. So, they got him on tax evasion. It was a technicality used to take down a giant. Fast forward to 2026. The Trump administration has been hammering Jerome Powell for months to lower interest rates. They want cheaper debt to fuel the economy. They want the stock market to rip higher. But Powell, stubborn as ever, has held the line, insisting that rates must stay where they are to keep inflation from flaring up again. So, suddenly, we have a DOJ probe into building renovations? Powell sees exactly what this is. In his statement on Sunday, he didn't mince words. He called it a pretext. He said, essentially, this isn't about drywall and plumbing. This is about whether the Fed sets rates based on data, or based on intimidation. Why does this matter to you? Because the Federal Reserve Act protects the chair. The president cannot fire the Fed chair just because he disagrees with interest rates. If he could, every president would demand 0% rates before an election to juice the economy, leading to hyperinflation afterward. To prevent this, the law says the chair can only be removed for cause. Cause usually means criminal misconduct, gross negligence, or malfeasance. Being too hawkish on interest rates is not cause. But, mismanagement of a massive renovation project involving taxpayer money? A scandal involving federal contracts? That starts to look a lot like cause in a courtroom. This is a legal loophole designed to decapitate the leadership of the central bank without technically violating the Federal Reserve Act. It is a brilliant, terrifying legal maneuver. And if it works, it sets a precedent that the Fed chair serves at the pleasure of the president, not the pleasure of the economy. Now, let's go back to that word Trump used in the Reuters interview, loyalty. He was criticizing Republican lawmakers who are worried about this investigation. He said, they should be loyal. In the world of politics, loyalty is currency. In the world of central banking, loyalty is poison. The entire value of the US dollar, the reason it is the global reserve currency, is based on the belief that the Fed is not loyal to any politician. The market believes the Fed is loyal only to its dual mandate, price stability and maximum employment. If investors suspect that the Fed is making decisions to help a president's polling numbers rather than to curb inflation, the trust premium in US assets evaporates. Let me explain the wallet connection here, because this is where it hits your mortgage and your credit card debt. There is a group of investors known as the bond vigilantes. These are the massive pension funds, sovereign wealth funds, and institutional investors who buy US Treasury bonds. When they smell political interference, when they think a government is going to print money just to be popular, they go on strike. They sell bonds. When they sell bonds, the price of bonds crashes. And when bond prices crash, yields skyrocket. So, here is the irony: Trump wants to fire Powell to get lower interest rates. But by threatening the Fed's independence, he risks scaring the bond vigilantes, which would send market rates higher. Imagine the 10-year Treasury yield jumping from 4% to 6% overnight because China and Japan decide the US dollar is becoming a political coin like the Turkish lira. If the 10-year yield spikes, your mortgage rate spikes. Corporate borrowing costs spike. The stock market, which is valued based on those interest rates, collapses. We saw a preview of this in the UK a few years ago with the Liz Truss moment. She tried to bypass economic orthodoxy with a political budget. The bond market vomited. The British pound crashed. She lasted 44 days. The US is bigger than the UK. We have the reserve currency. But we are not immune. If the DOJ probe is seen as a way to install a loyal puppet, the bond vigilantes will extract a heavy toll from the American economy. Let's assume the worst-case scenario. Or maybe the best case, depending on your view. Let's say Powell is out, either fired for cause or his term expires in May and he is replaced. Trump told Reuters he has two names at the top of his list. The two Kevins. Kevin Hassett and Kevin Warsh. Who are they? And what does their ascension mean for your money? Candidate 1, Kevin Hassett. Hassett is the former chairman of the Council of Economic Advisers under Trump. He is a tax cut evangelist. He is famous, or infamous, for co-authoring the book Dow 36,000 right before the dot-com crash. He is viewed as a loyalist to Trump's economic vision. If Hassett takes the chair, the market will assume a very dovish pivot. He would likely favor lower rates and deregulation. Short-term impact, the stock market might throw a party. Tech stocks could rally on the promise of cheap money. Long-term risk, if he cuts rates while inflation is still lurking, we could see a resurgence of price hikes. Think 1970s style. Candidate 2, Kevin Warsh. Warsh is a former Fed governor. He's younger, richer, and frankly, much more of a Wall Street institutionalist. He has criticized the Fed in the past for being too easy with money. Historically, Warsh is a hawk. He worries about asset bubbles. If Warsh is the nominee, it's a curveball. Trump might want him because he looks good on TV and is smart, but Warsh might actually keep rates higher than Powell. Market impact, Wall Street respects Warsh. His appointment would likely calm the bond vigilantes. It would signal that the Fed is still serious, even if the leadership has changed. But here is the catch. Trump said, "I'll be announcing something over the next couple of weeks." This timeline is aggressive. Powell's term doesn't end until May. If Trump nominates a replacement now, while simultaneously investigating the current chair, he is creating a shadow chairman. He is undermining Powell's authority for the remaining months of his term. Markets hate uncertainty. Who is in charge? The guy with the subpoena, or the guy waiting in the wings? If a crisis happens in March 2026, who picks up the red phone? We have to talk about the roadblock. The Senate. You might think, Republicans control the Senate, Trump gets what he wants. Not so fast. Enter Senator Tom Tillis. He's a Republican from North Carolina on the Senate Banking Committee. He's retiring, which makes him dangerous. Politicians who aren't running for re-election have nothing to lose. They don't need donor money. They don't need Trump's endorsement. Tillis has explicitly stated he will block Fed nominations until the investigation into the renovation is resolved. He sees the game. He knows the investigation is a pressure tactic, and he's throwing his body on the gears of the machine. Why does this matter? Because the Federal Reserve Board of Governors isn't just one guy. It's a committee. If Trump wants to stack the deck, he needs Senate confirmation. If Tillis holds the line, we could enter a period of paralysis. If Powell is fired or leaves, and the Senate refuses to confirm a successor, the vice chair takes over. But the vice chair is also subject to the political winds. This leads us to a potential constitutional crisis. Imagine a scenario where Trump fires Powell. Powell sues, claiming the firing is illegal. Powell shows up to work. The new guy shows up to work. 2 Fed chairs. 1 building. This happened in a way during the Great Depression with different agencies fighting for control, and it was chaotic. In 2026, with algorithmic high-frequency trading, a split-screen moment where 2 people claimed to run the Fed would crash the S&P 500 by 10% in an hour. Trump's comment, "I don't care," regarding legislative pushback suggests he is willing to steamroll norms. But the Senate confirmation process is hard-coded into the law. This is the friction point where the sparks will fly. To understand the gravity of 2026, we have to look at 1972. Richard Nixon was president. Arthur Burns was the Fed chair. Nixon wanted to win a landslide re-election. The economy was wobbling. Nixon was caught on tape bullying Burns to lower interest rates to boost the economy before the vote. He shouted at him. He pressured him publicly and privately. Burns caved. He lowered rates. The economy felt great for about a year. Nixon won in a landslide. And then, the bill came due. Inflation exploded. It wasn't just high, it was runaway. It decimated the American middle class for a decade. It took Paul Volcker in the early 80s raising rates to 20% to finally kill the inflation monster, causing a massive recession in the process. We are flirting with the ghost of Arthur Burns right now. The parallels are terrifying. 1. A charismatic, populist president demanding lower rates. 2. A Fed chair being pressured politically. 3. An economic backdrop where inflation has been sticky. If Trump forces the Fed to cut rates prematurely in 2026 to fund a renovation of the American industrial base or to offset tariffs, we risk uncorking the inflation genie again. And this time, the US debt load is $36 trillion. In the 1970s, our debt to GDP was manageable. Today, it is over 100%. We cannot afford Volcker-style interest rates to fix a mistake. If we have to raise rates to 15% to stop inflation, the interest payments on the national debt would consume the entire federal budget. The US would default. This is why the renovation probe is so dangerous. It's not about construction. It's about removing the guardrails that prevent us from turning into a banana republic with nuclear weapons. So, what happens next? As an investor, you need to game out the scenarios. Here are the 3 most likely paths for 2026. Scenario A, the Cold War. The investigation drags on. It's used as a headline weapon to harass Powell, but Trump doesn't pull the trigger on firing him. Powell finishes his term in May. Trump nominates Kevin Warsh. The Senate confirms him. Market reaction, volatility remains high until May, but no crash. The system works, barely. Scenario B, the Saturday Night Massacre. Trump fires Powell citing the renovation scandal as cause. Powell sues. Tillis blocks the replacement. Markets panic. Bond yields spike. The dollar drops 10% against the euro and yen. Market reaction, a sharp correction in stocks. Gold and Bitcoin hit all-time highs as people flee the dollar system. Scenario C, the capitulation. Powell resigns early to protect the institution, tired of the attacks. A Trump loyalist is installed as acting chair via a loophole. Rates are slashed immediately to near zero. Market reaction, the crack-up boom. Stocks melt up. Real estate prices soar. But 6 to 12 months later, inflation hits 8 to 10%. The long-term purchasing power of your savings is destroyed. Listen to me closely. The era of the boring Fed is over. For the last 40 years, we assumed the central bank was a technocratic institution. A bunch of nerds in suits looking at spreadsheets. Now, it is a political battlefield. When the President of the United States says I don't care about the independence of the monetary system, and demands loyalty from the people who control the value of your money, the rules have changed. This investigation into the renovation is a signal. It's a signal that the executive branch is willing to use the Department of Justice to bend the knee of the financial system. So, what do you do? 1. Watch the long end of the curve, keep your eyes glued to the 10-year and 30-year Treasury yields. If they start rising while the Fed is talking about cutting, it means the market is losing faith. That is your air raid siren. 2. Diversify away from the dollar. I'm not saying sell everything. But in a world where the dollar is being politicized, having exposure to hard assets, gold, silver, real estate, and yes, Bitcoin is an insurance policy against institutional failure. 3. Quality over growth. If we enter a period of Arthur Burns 2.0 stagflation, speculative tech stocks get slaughtered. Companies with real cash flow, pricing power, and dividends survive. The renovation at the Fed might just be about bricks and mortar. But if it leads to the demolition of the Fed's independence, the house that comes crashing down won't be on Constitution Avenue. It will be your financial house. Trump says he has no plan to fire Powell yet. But in the Game of Thrones that is Washington, D.C., a plan is only as good as the next news cycle. Stay liquid. Stay alert. And for the love of God, watch the bond market. I'll see you in the next one.